In the year 2021, that is generally hit by, by the woes of the pandemic, has ended quite well for the financial market investors. The one reason that becoming the growth of GDP sector after the sharp decline in the early part of 2020 when the pandemic has recently came in India as bring the adverse effect of the global economy, and now the global economic growth is recovering, and the expectation for the 2022, that current year, should be a moderate given the high returns over the last 2 years. The phase of consolidation amid the large bull market in the past two, that 142 lakhs first time the investor who entered the stock market, 142 lakh, and the 10.5 million US dollar, the size of the P2P, that is the lending market by 2026, the next 4 to 5 years, the estimate value of $10.5 billion actually, it is expected to grow at a compounded annual growth rate of 22% approximately during this tenure of 5 years, 2021 to 26. It's tough to choose apart from the traditional investment options such as equity, debt, real estate, and gold. The digital boom that during the pandemic has amplified the retail investors' interest in asset classes like peer-to-peer lending, cryptocurrency, and real estate investment trust. The Indian investors have also taken a fancy to the global equities in the last 2 years, and especially post the sharp rally in those internationally equity market after the pandemic has break in the last year. India's economic among the fastest growing economy in the world, and the stock market that led by traditional sectors such as IT consultancy, financial services, banking and non-banking regulation body, that petroleum and consumer staples. In contrast, the new schemes such as robotics, artificial intelligence, electric vehicles, cyber security, industrial automation, cloud computing, e-commerce, data center, and gaining the huge momentum in the developed world. They are visualize the growth of global economy, the future of global economy that depends on this type of massive technologies, and those investments that are relies or based on this technological, and these themes are expected to shape the future, and it's becoming a part of the portfolios. And there's a strong case for the international investing body to protest and protect the investor from the country specific risk, and it's also that the beating inflation in the next coming years is the key for the nation, as the Nobel laureate once said, that the Milton Friedman once explained that the inflation is a form of taxation as it eats into the purchasing power. If your income rises 10%, but the inflation goes up to 15%, you will have to lower the consumption by at least 5% to ensure that savings remain at the earlier level, it at a constant value. It's estimates, and that the important factor that in coming years we have to keep in mind, we have to focus to beat the inflation. And it's important to beat that despite the decent returns, one can end up becoming poor in the long term result. And it's equity that have beaten the inflation over the long term. Equity have also done far better than the other popular assets, such as real estate, gold, and the fixed income by a wide margin of the last one decade. And the debt market is expected to hit a bumpy road. Actually, a volatile debt market is also an important fight. Despite a stand by the RBI's monetary committee, policy committee, and the emergence of the new pandemic strain, COVID strain, that still be forced to increase the rate faster than its latest guidelines. Persistent price pressures and the inflation that will increase the pace of reversal. Property prices are also expected to grow up due to the continuously rising the prices of raw materials such as cement and steel. We already started seeing the 5 to 10% rise depending on the property, location, and available stock in the market. And another reason is the rise in operating costs due to the additional safety protocols and the expenses to take care of the vaccination and other medical needs of the workers. We need to think twice before we can set a demand to fulfill those demand of property in the real estate industry that is somehow additionally the last year many developers have been able to clear their inventory after demand surge due to this pandemic and giving them the elbow room to increase the prices. That's an interesting fact. And one time, all-time low interest rate and the discount make this good time to buy a house for the self-use actually. The investor also looking for some exposure to commercial asset and it's only financial efficient and well regulated for the mass and retail participation in the commercial real estate industry and that's the only way. The rental collections that have been good 98 to 99% despite the pandemic as well as those available stage own high quality office spaces. The valuation can also be quite reasonable for the similar opportunities compared to the valuation in the home country due to those opportunity deficiencies and scarce opportunities there in particular field. And in the short term, rates going up, it's return from the liquid or money market that the mutual fund should rise and the short term and conservative investor should stick to the categories like the liquid fund to benefit from the increased rates in the coming month, in the future time. And along with those liquid funds, the core fixed income, that allocation could be a short term debt fund and the dynamic bond fund with a low credit risk. The bond fund investor should opt for a longer holding period to ride those turbulence in the market, those uncertainties, some disturbance, fluctuation is intermittent that create those. Thanks for your time. Thanks for watching. See you in the next video.